Good afternoon, everybody. Can you hear me properly? Yeah. If there's any problems about the sound or whatever, if you could put your kind of hand up, and if there's any problems with the content, if you could put your hands like that, and I'll wrap things up quickly. So you'll be glad to hear I'm Ben Ashby. Otherwise, I'm nicking his investment presentation, which will be useful. Just before I kind of kick off, I just want to say thank you very much for making the effort this afternoon to come here in this beautifully understated room that even Elton John might have issues with. And the other one I just wanted to say as well, this is all kind of talking about patience and your past. And the reason why I perhaps kick off with that is one of my colleagues said, why do you have something that's always related to the sea, Ben? Is that because you look like a trawler boat captain? So, you're all witnesses at the employment tribunal, but more importantly, my family were indeed trawler boat captains, and that isn't the reason why I actually do it. They come from the Hebrides of all places, so which is the chain of islands. But the key thing is, even though I might have left there, my family might have left there, you can still get trapped by the decisions you get made in the past, and in my case, a very small genetic puddle. Right. So what the key thing is we want to talk about is this quote gets captured by Warren Buffett. It's not actually by Warren Buffett. It's actually by Jeff Bezos. And it's his reply, or Buffett's reply to Bezos. And he says, you know, Warren, you are one of the world's most successful investors. You've been around for 60 years. You've made all this billions for yourself and your investors. And yet your method is quite simple. You know, you do this, you buy undervalued stocks, you sit on them, all this kind of stuff, you make a load of money. Why doesn't anybody else copy this? And his answer was basically because nobody wants to get rich slowly. It's boring. And it requires patience, and it requires you sometimes to go against human nature, which I suspect a whole bunch of crypto investors are rapidly discovering at the moment, that oddly enough, you can't just create money and value out of code that easily. So talking about issues of the past, and apologies, these are quite small slides. I appreciate the room is quite narrow. We can send this on to you. I believe it's being recorded, so hopefully they'll slim me down as well when you hear that. But the key thing I wanted to kind of explain is everything we're experiencing today is a result of the monetary policy that we had a couple of years ago. So all this inflation, all the kind of problems that we've had flowing through the economy isn't to do with the Ukraine war, isn't to do with a 45-minute premiership of Liz Truss and one speech. It's largely to do with borrowing hundreds of billions of pounds and printing hundreds of billions of pounds and dollars and various other currencies. And then all you really needed was a spark, one way or the other, and it starts to feed through the system. So the Fed itself states that monetary policy acts with long and variable lags. And this is a really important thing when you consider everything they're doing today now. So they're pushing up rates. They're obviously imposing quite a heavy tax burden, quite spectacular, even by historical standards, with a country as old as the UK. And all of this is still to filter through into the real economy and into various asset prices. The cost of money is changing, and I'll explain that on the next slide, and that will reprice basically everything else. And it may even cause a much bigger regime shift in markets. And these things come along every 30, 40 years, and there's a definite change. So if you kind of think of one of the last ones you got in the UK was the late 1970s, you kind of had the big IMF restructuring bailout of the UK, a lot of problems, but you had a boom by 86. But you obviously had quite a lot of strife and political unrest in between there. So they do come along, they happen in other countries, and there's a high probability that we're about to go through one now, and they take a little while to work their way through. So what do I mean about the cost of money is being repriced? So this is a simple chart, so stylized, and I'm going to try and keep everything short. But essentially, if you think the price of cash is going up, then every other asset class, which have kind of higher expected returns but higher risk, which can be measured in a number of ways. I've done there as sort of like a volatility around a portfolio, so how much that portfolio would move around. So one of the reasons why you get paid more for being invested in equities if you're patient, is because they move around a lot more because of the uncertainty over time, but you do get paid for that. So all the evidence is if you buy a decent portfolio of companies, they're well invested and you sit on it, yes, it will move around, yes, it'll be a little bit scary, but that's essentially why you get a higher pickup for term. But what we've got at the moment is obviously cash going up, And that starts to push all these other investments and makes them look very different. So again, you've got this battle at the moment going on in the market with people trying to work out how much is the Federal Reserve, and there's a reason why I put the dollar at the top, how much the Federal Reserve is going to go up, and if they can work out roughly how much that's going to go up, then you can start to reprice everything else. But the key thing is, until they stop, there's a fairly good chance that there's going to be downward pressure on these asset prices, because the value of cash today becomes worth a lot more. So you're less bothered about moonshots in the future. So when the cost of money is zero, or even negative as we had in the Eurozone, you're more interested in potentially getting paid in the future with a high growth company. So that's the battle we've got going on at the moment. But that's not the only thing that the Fed's attempting to do. Because the other quality that you find with money is not just the cost, but what they call the tightness, the availability, the sort of liquidity in the market. So the Federal Reserve, as you can see, there's the GFC, relatively tiny now when we look back on it. And then we've got basically all the big QE expansions when they decided they needed even more money in the US economy. And then finally COVID comes along. So they're now trying to draw all that back. So this is the opposite of quantitative easing, it's quantitative tightening. So they're actually pulling cash out of the economy. And why it's so important in the dollar's case is because the dollar underpins everything. So when you actually go, so people talk about it being the world's reserve currency, but what they don't sort of understand is it's also the kind of architecture of the entire financial system. So if you go on holiday to Thailand from the UK, they don't actually convert your money at the wholesale basis from sterling into Thai baht. They convert it into dollars and then dollars into Thai baht. So basically, about 88 to 90% of the entire world's FX transactions go into dollars and then come back out of dollars. So if the cost of those dollars are going up, everybody that uses that from working capital or countries that have, where companies have borrowed for capital investments, say a hotel or whatever, and they're hoping to pay it back, that's all becoming more expensive for them. So not only is the cost going up, but the availability is coming down. And at the same time, if that wasn't enough, and as you can see the quote from Lewis Carroll at the top, when I've attempted 6 impossible things before breakfast, the US is also attempting to run a budget deficit at the same time. So they're now going to try and find a whole bunch of people to potentially invest. So who are these people going to be? It may well be the banks, because you're obviously taking cash off the banks. That's the opposite of QT. You take cash out of the banking system and you put it in there. So they're going to have to find replacement borrowers. So again, you've got this process going through for 2023, 2024. Another thing that you've got with the fallout of the Ukraine war is one of the things we discovered was Russia's very much stuck in the 20th century, both in terms of equipment, both in terms of how it thinks about itself, but also they're deeply in awe of Die Hard. So I don't know if everybody remembers Die Hard, which is the great Christmas movie, sounded like Deutsche Bank headquarters, bunch of Germans running around, policed, criminal activities. But the key thing is, if you remember, they have bearer bonds. And bearer bonds in this briefcase, and they were going off they disappeared 30 years ago. So it's all computer book entry. 95% of the world's money is computer book entry. Hence Mr. Putin waking up one morning and being very surprised that his account was frozen. So I genuinely wonder, with all the other chaos as we've watched this mighty military collapse before our eyes over the last 8 months, that they actually genuinely thought there was a vault somewhere with a load of suitcases. And don't worry, we'll be able to sell these things somewhere. So we've got that repricing going on. So to our mind, that's going to put downward pressure on asset prices. And they call that a bear market. There's a number of reasons why that comes around. Nobody knows for sure. But it's just part of the process of markets. And they come in different forms. And if you're interested, our last investor note talks about the different types, what kind of causes them, different sort of things. They do have technical names, but for a quick presentation, I will call them baby bears, mummy bears, and daddy bears. So baby bears are like COVID. Short shock, things go down, things recover relatively quickly, quite short market. Mummy bears are the standard bear markets. They come along every 4 or 5 years because the market's got a little bit ahead of itself, or one asset class has got ahead of itself, and there's a bit of a repricing. But every once in a while we have a daddy bear, which is basically where there's a bit more of a problem in the market. There's a bigger regime shift. They tend to have 4 kind of characteristics around them. So one is rising rates and widening credit spreads. Well, we've got that. We've got a wider economic recession. Well, Jeremy Hunt's guaranteed that for the UK economy. But also, the chairman of the Federal Reserve is talking about effectively doing the same thing for the United States. We have stretched valuations. We don't actually have stretched valuations for a lot of equity prices in Europe and the UK, but we do in the US. And the issue that we have is we struggle, if there is a wider downturn in the US, seeing other markets do well at the same time. We think they will, but there's a matter of timing about when you invest in there. And we'll also have a popping of asset bubble or bubbles. And I would say that we're beginning to see some of that going on, particularly in some of the bond markets. So one of the problems that when you have that is you get a long process as you work through, and there's these powerful short-term rallies. And there's a lot of technical scientific reasons why you get these rallies about investor sentiment. But the best way that I think of them all is like you're on the Titanic. You've been holed at the front and you're on the back of the ship and it's going up and you think, why are we sinking? Because I seem to be 100 foot in the air and the band's still playing. So that would be the way that I would view things. But we do have this kind of bottoming out process. So before you all take fright, I'm going to talk through about what we've done about it. But before we start, anybody that was here for our summer drinks, I kind of explained about investor psychology and how human brains are wired. And effectively, we have 2 types of thinking systems. We have type 1 brains, which is the basic stuff as mammals that we've had because of a process of evolution over hundreds of thousands of years, though obviously less in my case, because I pointed out I'm from the Hebrides. But also, we have type 2 thinking, which is the much more advanced thinking that's come around in the last 70,000 years with the big expansion of the human brain. And the problem that we have is type 1 thinking is what actually drives us most of the time. And type 2 thinking, that considered thought, tends to be much more quiet, and you have to give it time to think about things. Now, this is a fantastic book if you ever get the chance to read it, but it just talks about how we've just ended up in this culture of sort of risk, fear, and he talks about why 24-hour news cycles have driven us here, because when you look at things, everything objectively has got better. Mortality's got better, living standards have got better, everything's got better, but actually everybody feels the country's falling apart, things are getting wrong. And he talks about effectively the problem of having our Stone Age brains wired in with this amazing pieces of technology and a bunch of people that have a lot of interest in creating headlines or for whatever reason telling you to do things. So the key thing is, going through, is bear markets are actually amazing times to buy assets. But you have to be patient and you have to be calm. So the person at the top is one of those amazing investors that nobody's ever heard of, but he actually outperformed Warren Buffett for decades. But one of the problems he had was he died a lot earlier. But hence why we haven't heard of the gentleman outside of Warren, which shows the advantages of history and longevity, if nothing else. But one of the key things is he's put there, and I could have given you pages and pages of quotes of very, very famous and successful investors that talk about actually just being patient, and actually these are great opportunities to buy, even though our type 1 brain, our Stone Age software, will tell us that these things look very scary. So the first thing is stay calm. Secondly, as you know from performance this year, we've avoided the most aggressively priced parts of the market. And as the old regime dies, going back to that example of the investor psychology and the bounce up, people will say, well, actually, Apple's still a great company. Yeah, it is a great company, but you paid an amazing price for it. So again, you've got that thing where people feel the old regime needs to come back. These things are cheap because they used to be worth $1,000 a share. Now it's worth $500. That's got to be a bargain. Well, actually, it depends. It depends on the price and what's happening to the company. It's still an amazing company, but as Buffett says, the trick is not to pay an amazing price for it. So we've got that. So we've avoided a lot of that. We've rebalanced towards what they call value-orientated investments, and there's a couple of those ways that we've done that. So we've taken down the risk exposure in the portfolio, but we've also focused on boring businesses that generate a huge amount of cash in the short term, because we want that cash to kind of be generated, because in a world where interest rates are going up, that cash is worth a lot more in the short term. We also have a plan about reinvesting back in. So I thought what would be useful if we kind of talk about the leverage cycle and how things move through. So this simple chart, which I stole off Citigroup, and I know there's some fellow ex-JP Morganites in here will recognise that this was a chart that Citigroup stole off JP Morgan many years ago. But they've presented it a lot better than Morgan ever did. But essentially it just talks about the kind of credit cycle that you have in the economy and how things work their way through. So what we've had for the last few years is equities have been going up, but the credit quality has been going down. The biggest buyer of US equities over the last few years have been US corporations. And how they've managed that is that interest rates came down, they borrowed more and more money, and they borrowed that money to buy their own shares, which pushes their equity price up. With a rising rate environment, a number of them are going to realise that they shouldn't have done that, and they should have had more cash and equity in the balance sheet. So we're starting to get to that point there where you've got a bursting of the bubble with the higher rates. So equities will come down and credit comes down because basically all the people that lent to these companies thought, actually that doesn't look like a great idea. These things are going to come under pressure. So we think we're in that process now where things are kind of just beginning to break. So the next thing we want to do, and anybody that's looked through their portfolio would see you've already got a relative component of credit. What is credit, by the way? It's corporate debt. So it's corporate loans to high quality companies in our case. We haven't touched any of the stuff that's of lower credit quality. But effectively, as rates go up, with shorter dated corporate debt, we can take advantage of those rates as they go up. The other thing that happens, which you can see with the green bubble, is what always happens in the credit cycle is they fire the old guys, blame them for wrecking the company, do a rights issue, which means issue more shares, which isn't bad for equity, but it's brilliant for debt holders, or they start selling divisions off, all of which is great when you've lent the company money, not so great for the equity side of things. So during the course of this year, we are likely to be taking a bit more advantage of those credit spreads as they've gone wider. And then you get the recovery in the economy and credit goes up because the quality of the company's improving, the earnings are going up, and everybody's a winner until the cycle comes back again. Just taking a couple of long-term views. So the first thing is famous American philosopher Ferris Bueller, which I'm sure all of you remember. So Ferris Bueller was a very popular teen film in 1986, which would make him 53 years old now. So possibly worked for Sears, which was the world's biggest retailer 30 years ago in Chicago. It's now down to 6 stores and probably won't make this Christmas. So just showing how things do move if you don't look around every once in a while. But Ferris Bueller, look at the bigger picture about some of the stuff that's going on. The budget that they announced yesterday is effectively a very close replication of something the UK did back in the 1920s called the Geddes Act, where they effectively tightened into a recession. They did a lot of fiscal contraction, which is effective taxes, as well as rates were going back up for various reasons. It didn't work. In fact, the entire track record of the UK successfully doing austerity is 0. Entire track record of pretty much any country doing austerity successfully is 0. The only few countries that have ever managed it are all relatively small, and they were very much neighbours of a much bigger economic bloc that did better at the same time. So they were able to do it largely because their neighbours were expanding at the time and they were doing well. So I think there's a good chance that they'll come to regret the budget, probably within 12, maybe 18 months, as they work out it's going to be a much deeper and more unpleasant recession than they expected. Which also brings around the question of there's likely to be a change of government, and will we find that it's going to be like the 1970s, where we've got a Labour government coming in, which generally tends to run a expansionary fiscal policy, but they won't be able to because effectively where the economy is. The other question that you have as well, and this is going to sound like a bit of a political statement, but I'm going to sort of run through with some of the voting patterns. But if you look at the budget that was announced yesterday, you can see the 2 key voting blocks that the Conservative Party is attempting to appease. So one is the wealthy pensioner bloc, because that is a big chunk of their voting. And the other one is, again, the red wall, which are heavily dependent on public services, why they've pushed a lot of those cuts back. So the reason why I bring that up is if we do have a change of government and they do want to run a fiscal expansionary policy, that isn't their voters. Their voters would be the exact opposite of that. So as you know, on the run-up to the budget yesterday, or I should say it's autumn statement, but budget for all intents and purposes, they trialled the idea of more inheritance tax. The Conservative Party is very unlikely ever to do that because that's not where their votes are coming from. Very, very few people, if you look at the polling now, under the age of 47, vote for the Conservative Party outside of those two blocks. So that would be something politically that the Labour Party is able to potentially fulfil their balance sheet promises, or sorry, their expenditure policies against that bloc. So the reason why I bring it up is just bear that in mind about careful planning, about consideration, particularly around inheritance tax. There's also a much bigger social economic change going on. I'll come back to that. Energy issues are likely to persist for a fair few years. It's not just the Ukraine war. It's basically we've attempted to violate a lot of the rules of physics, which as somebody who did science as an undergraduate is a bit upsetting. But the key thing is we haven't really invested in oil and gas fields for nearly a decade. These things burn off every year. There is ever-growing demand from the rest of the world. So those prices are likely to persist for some time. So they might be volatile, but I think if you're looking at a longer-term structural trend, it's going to take years to replace that gap in supply. And we've still got a lot of technological change, which, going back to the Dan Gardner thing, is largely positive. This is what I was talking about, changing electorates, and we could talk about the UK, but since we've just had the US midterms, I thought it was very interesting. But it's effectively the collapse of the middle ground in the United States. So this is from a very respected research body called the Pew Research Centre. They do stuff on the UK. They cover a lot of different countries on a lot of different issues. But as you can see, back in 1994, there wasn't a lot of difference. I was listening to a podcast recently with Rory Stewart and Alistair Campbell, and they had William Hague on, and they were talking about, well, actually, if you look when William Hague was running the Conservative Party, there wasn't a lot of difference. There was a sort of argument around a few key points about how they were going to do things. But actually, you start to look at where those two wings of the party are getting now, and there's enormous differences. And you can see it in the States, that from this, they've picked a bunch of issues where they think there's right or left-wing kind of views of things, how the Americans define it. And you can see there's just this large collapse going on. So it'll be interesting for the US election because effectively Biden's able to kind of hold them together. But as you can see on the Democrat side, it's moving definitely to the left, and the Republican side is definitely moving to the right. And there isn't a lot of sort of, dare I say, sanity left in the middle. So key messages for the whole thing. We are heading into rougher waters, but there are going to be lots of opportunities. As this quote here, I said I could find a series of pages for you, but this is from Sir John Templeton, who was an incredibly successful investor in the 20th century. But for those that are properly prepared in advance, a bear market in stocks is not a calamity, but an opportunity. So we think we're going to have downward pressure. We're being very careful, as you know, with your capital. We've done pretty well this year about protecting it. But we think we'll get much better opportunities to redeploy it, probably starting off in credit, and then potentially we'll walk ourselves out into kind of other parts of the market around certainly equities. So we have positioned your portfolios for this. It is worth looking at your wider investments, partly because I've talked about potential changes with inheritance tax, but also I know, and it's going to sound like a pitch, but I know you have money with other investors. But we spend a lot of time looking at the portfolio, how it's going to trade, what scenarios are going to work in, what affects it. If you're running a portfolio and you've got your money elsewhere and they have got 20, 30, I think the most we've seen is 50 fund managers. 50 fund managers running different funds with hundreds, if not thousands of securities under there. I'm very sceptical they have a good idea about how it will perform in a regime shift and a very different market environment. So I'm not suggesting moving your money, but that would be lovely. But so you feel a lot happier about us, it is worth having a look about how they manage it, what are they doing with it, and just honestly think, what are they attempting to achieve? Because you get a concept called diversification, which works, but once you get beyond 20, 30 stocks, for example, you don't really need more. So if you're at the point of several thousand, you've got diversification, which is effectively you're blundering into stuff that they have no idea what's going to do, and it may well underperform. So the future does remain bright. So talking about the UK in 76, we went to the IMF. By 86, it was a massive boom and everything was recovering. So time does change. It does look darker before the dawn. But We think that's where we are at the moment. We do think there's going to be some great opportunities, and that's basically all my presentation. Though compliance does tell me I need to show you this to say that you shouldn't listen to anything I have to say, and I am completely unreliable to have any kind of opinion about anything. And that's all for me, unless there's any questions. Thank you very much.